IVM.
Welcome to All Things Policy, a daily podcast by the Takshashila Institution. We are a bunch of policy nerds based in Bengaluru, and we like bringing fresh perspectives to Indian affairs and Indian perspectives to global affairs. So grab a cup of coffee, sit back, and join us for today's chat. Dear listeners, as 2019 winds down, we want to thank you for your patronage. It's your support that's helped All Things Policy grow from strength to strength this year. Today is our last episode of the year as we break for the holiday season. But we'll be back on track in the new year starting from January 2nd. Until then, we hope you have a wonderful Christmas and a happy new year. Now on today's conversation.
Hello and welcome to All Things Policy. I am Pranay and today I have with me Apurva and Anupam. And today we are going to discuss one of our specials of 2019 in review. We are going to discuss how the Indian economy has fared this year. And no surprises for guessing. We all know that it is in trouble. So we are going to diagnose some of those things. Before I get into the conversation, I just wanted to mention if you're looking to transition to a career in public policy, come and study at the Takshashila Institution. We offer both graduate and postgraduate programs in public policy. Applications are now open for the upcoming January 2020 cohort. Please visit our website takshashila.org.in to find out more. Okay, so back to the economy. Apurva, where do we begin?
Okay, so let me begin, Pranay, by talking about the Indian economy's report card. And unfortunately, there are many red marks in the report card. So we start with the relationship of GDP with respect to other factors that determine the GDP. Y is equal to C plus G plus I plus X minus M, where Y is the GDP growth, C is the domestic consumption, G is government expenditure, I is the investment, X is the exports, and we reduce imports because imported materials are not produced in the country. So we reduce the imports. So the relationship is X minus M. Okay.
So now that is clear. So Y, which is the GDP, is the sum total of all these. Now let's take Y itself. This GDP itself, there is widespread news and there are counter proposals as well, people saying that the GDP hasn't reduced. So what does the macroeconomic picture tell us about Y?
So as per the latest GDP figures, Pranay, the GDP growth in September quarter in India was 4.55%. This growth is the lowest in the last 6.5 years. This is also a sixth successive quarter of deceleration. So it's pretty bad. And there are many factors that have determined this slowdown. Let me start with the first factor, that is the C, that is the consumption. And we all know that the latest NSO figures, which were quite contentious, has sort of argued that the consumption have declined drastically over the past 6-7 years. And so that's pretty bad. There is a macroeconomic indicator called private final consumption expenditure, which is a proxy to private consumption. In the last quarter, it has improved slightly, but it is still very bad. Talking about consumption and demand, the electricity demand has fallen by 4.3%, and this electricity demand includes industrial as well as domestic. The reasons cited by some of the economists are that the existing projects are not performing that well, and the new projects are not coming up. So that's on consumption part.
I think the best way to really get a hold of this is Y is nothing but, I mean, you can look at it as GDP, but I think in even more relatable terms, Y is nothing but income, right? It's national income ultimately, which means it's sum total of all the income of all Indians. And we can see that it has been, of course, decelerating. That is, the rate of growth of income has been reducing. And the latest figure says 4.55%. But I think the more worrying trend is that from, let's say, 2013, which was the worst year in terms of economic growth for India in the recent past. After that, we saw quite an improvement, right? 2014, we saw about 8% GDP growth. And then since then, it's been falling continuously. And that's not really, I mean, that is something to be worried about.
Yeah, I mean, I think Nitin had tweeted this thumb rule, right? Like for every % of GDP growth lost, around 1.7 million people have not been able to escape the poverty trap. Right?
Yeah.
So that is the relatable cost.
Exactly. So which means that if you're growing at 4.5% instead of, let's say, 7.5%, that's 1.7 into 3 million people who have not been, taken out of the poverty line or poverty traps, right? So that is significant. That's why it's important as to why we even track GDP, why we look at how incomes are growing, how much it's growing, and so on. I think there tends to be this unfair kind of criticism that we are too obsessed with GDP as economists, but this is why it matters, and it's important to kind of remember that.
Yeah, it's an indicator and it has flaws like many indicators, but let's not go into that discussion. But let's come back to India and economy in review. So Apurva told us about how consumption is declining and there are various parameters which attest this. What explains this? Why is C going down?
So the simplest way to understand this is, of course, that if your income is going down, your consumption would go down. Right? It's a completely intuitive kind of understanding of this, that if I earn less today, then obviously I'll have less to spend today. Right? And that kind of feeds into the next year's income, because if I'm spending less today on various things, then because it's a macroeconomic cycle, then fewer people get their incomes, and because of that your overall economy depresses. So it again, everything in macroeconomics goes around in circles. So if you have lesser incomes today, then it means lesser consumption, but if you have lesser consumption, it means lesser income tomorrow. So that kind of feeds in.
No, but we are discussing the right hand side of this equation. Okay, you can't explain the right hand side using the left hand
in
side. In
macroeconomics you can.
No, that's why we don't like microeconomics.
So the right hand side of the equation for this period is explained by the left-hand side equation of the previous period. So because GDP or incomes were low in the previous quarter, obviously consumption will be low this quarter, and because consumption is low this quarter, incomes will be low next quarter. So that's the kind of cycle in economics, right?
Okay.
But that's the broadest thing. There's of course more nuanced ways to look at this, which is that once you have, let's say, people's expectations in the economic growth story matters a lot in macroeconomics. So if people expect that the economy is not growing, or that at least what that translates to is that their own job is not probably secure, or that their income is not secured, or they'll remain on the same level of income, or if they expect that their income will not grow as much they expected, then obviously the consumption will also reflect those expectations. So if you basically expect that your income is not going to grow, or it's going to remain stable, or it's actually going to go down, then how much you spend today will obviously decrease. You might start saving more because you expect rainy days ahead. Right. So that, I think, explains a lot of the consumption pattern. So if you remember, we went into this entire story about declining auto sales, right? Apurva, if you would remember this. Auto sales fell massively. I think Maruti and so on had the worst kind of quarter in the last 10-15 years, even worse than what happened in 2007-8, or at least worse since then. Tractor sales fell. You had two-wheeler sales falling for the first time in India and for a long time. There were reports of stockpile growing out of hand, inventories increasing and so on, and that people are just not buying. And all of this is reflected in that consumption slowing down thing. People do not buy a car if you don't expect your incomes to grow. Right? Because you can't pay back the loan, you can't at least afford it, and so on. So all of these things matter. The same way electricity consumption, you start saving a little bit more, some other consumptions. All of these things go down. These are all indicators of the overall kind of the story of how people's expectations about the economy is forming. And expectations and reality go hand in hand. Your expectations are formed by reality. But then because there's a self-fulfilling prophecy in macroeconomics, the reality comes true, or rather the expectations come true, right? Yeah. So that's what happens.
That's the basis of the book Narrative Economics, right? Nobel laureate has written. But let's go back to this idea about consumption. So basically what you're saying is people have deferred consumption, especially the more elastic consumption has been deferred because that you are not sure whether you're going to get the same income later or not.
Exactly.
Okay, so that has happened, and probably a few events in the past lead to this. Let's say uncertainty with demonetization, and then what happened with GST, even that is not settled, like people are still not getting their input credit. Yeah. So that also has an impact on this C, right?
Yeah, definitely.
So a lot of consumption decline is because of the stagnating rural wages, Pranay. And the rural and and when I say rural, it includes all the agricultural incomes and the non-farm income. And these are based on cash. And after 2016 demonetization step, they were cash strapped. And that's why that was a trigger point of the entire collapse of the rural economy, and that is reflecting in the consumption also. Few days ago I was reading an article by an economist who says that the consumption of not only the tractors but also the men's innerwear has also reduced. That's the kind of slowdown we are looking
Though I
at.
would shudder to think that it's an inelastic expenditure.
No, but here's the interesting thing. I was just telling someone else that the for me the indicator that worries me the most is the fall in FMCG sales. Right? People do not normally reduce their consumption of FMCG. So basic things like toothbrush and toothpaste, your innerwear, and a lot of these things, these are more inelastic consumption patterns. So if that has actually fallen, I think that's one of the best indicators, even more than a car. Right? Correct. It's one of the better indicators that there is slowdown in wages, that people's expectations are going down, and all of those aspects.
Yeah, I totally agree. Instead of GDP, we should just count the number of innerwear sold. Overall, right? Yeah. So fine. So this is about this C. What is the next factor, and where does that stand?
So the next factor is the government expenditure, right? And government has tried in the past quarter. Government has tried to increase its expenditure, and it has stepped up its expenditure by 15.6% in the quarter of July to September. But this is not enough. Looking at the enormity of the crisis, this is not enough. One of the biggest challenge is that you need to have fiscal prudence as well. So this is a very sort of challenging and contentious issue facing the government.
It's not just this quarter. I mean, if you look at the past 2-3 years where, as we mentioned, the economy has been slowing down, it's the government expenditure, both in terms of its own consumption and investment, that has been at all-time highs, right? And in fact, if you looked at 2018, for example, just even before the end of the second quarter, the government had spent more than 80 or 85% of its intended expenditure. So it means that the government is desperate. They are spending, and yet there is this, as Apur mentioned, there is this one constraint, which is the fiscal deficit rules. But it also is quite reflective of the fact that, if majority of your investment is coming from the government as against private investment, I think it tells a really big story. And similarly, in terms of consumption expenditure, in terms of other expenditure, if government expenditure is right up there and it explains a lot of the GDP growth, then again, it's actually an indicator that the economy is not doing well, right? So that, I think, is something that, again, has gotten a little bit of focus on, but not enough. And again, all of this feeds into your fiscal deficit rules and so on, which is one of our favorite topics. We've spoken enough about this. But the fact is that the fiscal deficit, what they stated, again, may not be true at all. I mean, we are now, unfortunately, in an era where I think every single number that comes out of the statistician's office of the government can be questioned and should be questioned. So they might claim 3.4% fiscal deficit, but I actually say it's more like 4.5 to 4.8%, realistically speaking. So, because of all the things, we don't have to get in that. I think we might have 2 ATP episodes on just this one thing. But the fact is that the government has been trying to compensate for the fall in consumption and investment.
Yeah, so let me just bring in on this G, right? This idea. See, government expenditure has to be financed by someone. Either you are going to borrow it, or even let's assume government does not want to follow fiscal deficit and FRBM targets. So government needs to raise the money from somewhere, which will come either through borrowing or through taxation. Yeah. Now, where are we on that? Taxation, if you see, let's keep the GDP constant for now, right? LHS is constant. So fine, even if the GDP is constant, we should have seen raising of, if the GDP growth is constant, we should have seen tax rates increase. but that has not happened to that same level, right? Now with GST also there was this idea that we will see a massive increase, not just in the indirect tax collections but also in direct tax collections, because now you can do matching better. So people who used to hide their incomes not through false invoicing etc will get caught. But that hasn't happened, right? After so many months, finally GST collections crossed 1 lakh crores just a few days back, right? So that is worrisome. So tax rates haven't increased, and that's why the G part also cannot increase, like to even if the government wants to increase it, they can't increase it substantially.
Not through taxes, but they have been borrowing more, which is where the fiscal deficit shows.
Right.
Now, again, that borrowing, who does it borrow from? In fact, the Indian economies, or Indian Union government's borrowing from external sources is quite limited. It's not alarming to any sense. It's our external issuance of debt, for example, is quite low. That's not the problem. So we borrow largely from ourselves. That is, the Union government borrows from the taxpayers or anyone else who has money. It does it through the banking channels, not directly, of course. Now, if banks have all lent to the government, basically it amounts to the fact that banks don't have any money to lend to corporates or individuals, which again feeds into the low consumption and investment rate. So this is a classic case of the crowding out problem, right? If you have a government which is spending so much, then, and it's borrowing, then basically banks do not have money to lend to others.
Yeah, but the reason I didn't bring borrowing into this is because there is a limit to which you can do borrowing sustainably, because you need to pay that somehow, right? And if you keep borrowing, then your interest rates will also keep increasing if you are you're sitting on a huge pile of debt. So you can possibly think of increasing tax revenues year on year, and but if you're entire trajectory is dependent on borrowing, then you are going to hit the wall sometime.
No, just try to imagine this, right? I think we are now getting to that stage of, it's not, I don't want to sound alarmist, but that DOMA debt condition, basically, which says that nominal GDP growth should be higher than your basic interest rate. What is a nominal GDP growth? It's extremely low because inflation is very low now. It's hovering around, I think CPI inflation is around 3 or 4%, or lesser. WPI inflation is negative for a long time now. It's just about touch positive, right? You take that and you take real GDP growth, which is 4%, 4.5%, even that is debatable. And it's it's extremely low. What is our interest rate? Rate of interest in what the government borrows is again around that time. So we are hitting that very crucial kind of scary stage where most of what that means is that most of what we earn will just go towards repayment of our interest.
Yes. Okay? That becomes unsustainable with that.
And that's a very scary situation. I'm not saying we're there yet, but we're heading towards that. And for me, that is something which we should be alarmed about at least a little bit.
So can we move to something less gloomier, I hope?
Sorry,
which is I.
There's more terrible news at that.
Absolutely. So I is the investment, and one of the proxy for I is gross capital formation, which essentially means the investment in building machinery and other infrastructure and stocking the capital. It has remained flat over the past several quarters, and it was at its highest somewhere around mid 2000, where the banks were giving loans to the private companies. But after the NPA crisis and the projects that were not kicking off because of other factors, the investment rates have actually stagnated. And this particular crisis, and this was the seed of the NPA crisis in mid 2000. So investments have actually flattened. Talking about a tax, Pranay, you talked about tax revenues. I just want to give you one statistic. The union government's gross tax revenue dropped from 11.2% in 2016-17 to 10.9% in 2018 and 19. And India's
as a percentage of GDP.
GDP. And we all know that India's tax to GDP ratio is actually terrible. I mean, it's one of the lowest in emerging markets and developing countries. So that's where we are in investments.
Again, there's actually a bit more bad news coming on that front, and we've also done an episode on investment in ATP. So if you are interested, please check that out. Investment has been falling not just for the last, or it's been stagnating not just for the last few quarters, but if you take a slightly longer horizon, let's say the last 10 years or so, investment rate has actually fallen by 10 percentage points. So it was about 39% in about 2008-9, just before the crisis or just after the crisis, as a percentage of GDP, and now it's about 29% of GDP. So you've actually seen a 10 percentage point drop in investment. And if you look at, by and large, the engine of growth in an economy and an emerging economy especially, it should be investment, right? It should be especially private investments, but we'll get to that. It should be investments by and large. And if you're seeing that investments have been falling, and quite related to that is a fall in savings rate. Again, savings rate has fallen by a similar amount. So you don't have savings, you don't have investment, you have a completely broken banking system which is unable to lend. External commercial borrowings that can increase, but there are very tough caps on all of that. The only saving grace is investment in other countries, which comes through FDI, right? But all of this tells you that there's a massive credit crunch here. Right, there's a shortage of credit. People are unwilling to lend, and thus there is not enough for people to borrow and then make healthy investment into the economy, which can be productive, which can create jobs, which can create incomes, which can raise consumption and ultimately, raise the GDP. So I think that's the really big structural when you hear economists speak about, structural versus cyclical and so on. The investment problem in India is the structural aspect of it. Consumption can be probably cyclical, that, for this period, because people's expectations are low, there's consuming less. But, when things start getting better, they will again start buying more toothbrushes. But at this point in time, the fact that investment has been falling steadily for the last 10 years or so is your real structural problem. And that is tightly linked with your gross NPA problem, your balance sheet problems of the companies, and all of these things, right? All of this fits in very well with understanding why our investment has fallen for the last 10 years.
Yeah, and I think in this year we had banking reforms, so-called reforms attempted, where the government gave some more money called recapitalization to banks. But we haven't seen anything which that recapitalization leads to any reforms of some sort and actually changing government behavior towards doing better investment decisions.
Recapitalization should only be one aspect of the entire banking problem. I mean, I don't want to again get into the entire NPA problem because that's a huge thing by itself, but you recapitalize a bank as an emergency measure, right? It's the same thing as, if you're having a broke friend, just giving him a little bit of money to tide over the next couple of meals will only go so far. But ultimately, you want that person to find a job. In the banking crisis, the parallel is you got to reform the way lending is done by banks, the corporate management of banks, privatization of banks. I mean, the fact that we still have large public sector banks, which are the dominant form in the banking industry, is just insane at this point. Again, so you got this thing that they did of merging different public sector banks is a copping out. It's a lazy cowardice move. What you really need is privatization of your large public sector banks, professionalization of the board, better rule-based decision making in terms of who gets a loan and who doesn't. Then removing the straps that you've put completely, massive hurdles that you've put in form of the banks, which is basically, your SLR requirements, statutory liquidity ratio requirements, your credit ratio requirements, and then priority sector lending. All of these things are basically, completely hampering the way that banks can lend. And then, of course, we are surprised the fact that they're not lending to private borrowers. How is that even supposed to be a surprise, right? You've seen the writing is on the wall.
Right. Let's go to the next bird then. M-X. What's the story there? The external sector there, right?
Okay, so it's X minus M, so export minus the import. So I don't have a specific statistic on exports, but in the last quarter, the exports have improved marginally. It has not improved drastically, but it has just improved marginally. When we are talking about a government expenditure, pumping in money in the form of fiscal stimulus, here is how this will impact X minus M. If you pump money, the demand of goods will increase. The demand of goods will increase, so people will buy more, and hence the imports will increase. Now, when the imports will increase, the X minus M, which is also known as current account deficit, will also increase. So that's why whenever, when I say that in Indian economy needs a fiscal stimulus, it has to be a very balanced and sort of a calibrated stimulus. The stimulus should not overheat the economy. This is what we did in 2009 and 2010 in a series of fiscal stimulus. The third stimulus was actually the third stimulus in 2010 hampered the economy in a way that it stoked inflation and it increased the current account deficit, and that brought down the previous regime, UPA2 regime. So that's on exports.
We don't know whether that brought down the UPA2 regime. No one knows.
Yeah.
Okay.
We can't draw causation like that.
Okay.
But the export story, again, if you take a slightly longer view, is not really great.
Anupam, tell us something good.
There's no good news.
No,
don't
this year
expect
you
good news
should
from an
tell us.
economist. Not at this current climate. So, you will not get any of those. I mean, the last good news probably goes back in the economic front is the bankruptcy and insolvency code. And I hear even that is failing presently, right? There's not enough national tribunals who can hear these cases and so on. But anyway, the exports, again, the point is, if you look at just India's position in all of this, right? Let me pick up. So while he's providing all the important stats, I'm just giving you stories, right, of what India is doing and so on. The entire trade war is going on. You've got US and China fighting it out. A lot of companies, US companies who were well established in China, are actually moving out of China because they're losing out on the trade. Because of the trade war, you've got companies relocating and so on. And everyone would have assumed that India is a natural destination for some of these companies, and India was in the perfect position to take advantage of a trade war or anything that would hurt China, right? But that's not happened. And the fact that we have not been able to even take a little bit of an advantage because of this trade war reflects extremely poorly on us. In fact, that all of the companies are moving to Vietnam. All of the companies are moving to, Cambodia and Laos and so on, right? Whereas India is supposed to be, in that natural position to take advantage. We are a large English-speaking nation with a large market ourselves, so you don't have to worry too much about exports. All of the conditions are set right. But we couldn't take advantage because of, again, a whole set of domestic factors. Our labor laws, our land laws, blah, 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 which we have spoken about multiple times. But that gives you an idea of how poorly India is placed in the entire global trade regime. You can pick any one of these other indicators as well. For example, if you look at India's share of the global value chains, right? It's abysmal on anything that the world wants. Our share in global value chain is abysmal. Forget about semiconductor chips and so on, which is supposed to be, very high-end manufacturing. Even things like an LCD monitor, India's share in the global value chain is 0.04%. Why is that? Right? I mean, it tells you that we are just not exporting enough. We're not making things that the world wants. And we are also, creating massive trade distortions. One way out would be just, completely remove trade barriers, allow the markets to determine what is it that the world wants, invest in India, and then export to the rest of the world. So there are various such things that can be done, but I don't think we are, in a position where we are able to take advantage of this. Let me give you another indicator, right? In the world, by and large in world history, any time that a country's currency has depreciated, they've at least been able to take advantage of that and export now because, you're more competitive in the world market. If you look at India's currency from, let's say, just before 2013, which was about 55 or to 60 to the dollar, and in a matter of 5-6 years, we've gone to about 72 to the dollar, right? In those 5-6 years, our exports have not increased at all to reflect that.
Yeah. It should have aided
exports. Should have, right? That's a natural equilibrium. That's what economists talk about. But again, it comes down to the fact that we probably do not have a comparative advantage in goods and services which the world wants, and we're just not producing enough of those things.
On this count, right, maybe it's all right for, in the situation that we are in now, for M to increase, and because the imports are required in order to export as well, right? So for example, you need Make in India, but for Make in India, you might need to export a lot of machinery from outside.
Import a lot of machinery.
So basically, M might increase in the short term, but to increase X, you will need to have increase them in the shorter period. Is that right to say?
I am a massive believer in that. I don't think we should get spooked very much by our present current account deficit, because as long as we're able to finance it, and that is through the FDI and FIIs, I don't think that is a real big problem. And we are also sitting on $400 billion of forex reserves, right? So we have to liberalize our trade, which means in the beginning we might get swamped by foreign goods, which is okay, but that is probably how we can even get ourselves out of some of this mess, right? Once you have a liberal trade regime, then you will, there are people who will import stuff, then add value to it, and then re-export it to the world. Now, we do that in very few things like gems and jewelry and so on, where our basic contribution is just value add, but we can do that for a lot many more things, right? And that will only happen if you liberalize the trade regime.
Yeah, and one more indicator of that was the fact that India couldn't sign RCEP this time. So it happened this year, and it was made out to be some great decision of economic nationalism.
It was a complete sign of insecurity and cowardice.
Yeah, again. And maybe it was in per se the decision might be right, because today we are not in a position to sign RCEP. Maybe not. I wouldn't question the government on that, because I don't have any better data myself. But the fact that we should always worry is, why were we not in a position to be able to sign the RCEP? And will we be in a position next year?
Or 5 years down the line? Yeah. I don't think so. I mean, we are not doing anything that convinces me that 5 years down the line we'll be in a much better position to sign something like RCEP. Any country would try to be part of a exclusive club which has got some of the biggest other economies in the world, right? And having a free trade arrangement with them. But the fact is that we are so insecure that, again, comes back to the fact that we are not producing anything that the world wants, which is why we are scared that we are just going to get dumped by foreign goods.
Okay, so what else? So we discussed all the components. Are there any reforms that are needed to increase the other parts of the equation?
See, I think there's just the various other things of the macroeconomic variables that you can look at, right? I mean, for example, inflation has been my only good story in all of this is that inflation has been under control since we had a monetary policy committee. By and large, inflation has been under control. It is well under the desired rate. In fact, sometimes it's been too low for a quick growing economy, but that is because of the economic slowdown, right? Once you have a slowdown in GDP growth, inflation will also come down. But even before the slowdown happened, I think that was under control. So that's one of the big good things that we did, not necessarily in 2019, but quite recently, that you have a monetary policy committee which looks at monetary policy and this thing. In fact, your interest rates have been coming down this entire year, again linked to the slowdown, but that's also what's been happening on that front. I really cannot think of something amazing that has happened in the economy in this year. In fact, if you look at how a company is doing and so on, you've had stones thrown at Amazon and Flipkart with your something called an e-commerce policy, right? That is again, which will probably have repercussions later on. You have now a data localization bill of some sort, which will again have repercussions for the economy. Apurva, can you think of one amazing development in the Indian economy this year?
I think these are, most of the interventions by Ministry of Finance were first aid measures. So a few months ago, Ministry of Finance reduced the corporate tax rates. And economists have several economists and scholars have said that this supply side measures are not going to boost the consumption and demand. So you need some sort of the interventions that can boost the demand. So these are some of the band-aid measures, and I'll come back to consumption, Pranay. In the entire relationship between all these factors and GDP, in India, it's the consumption that drives the entire GDP. The consumption bit has a large proportion because we are a large market as compared to China or East Asian tigers, in which exports sort of drive the GDP growth. And so, for me personally, it has to be consumption that needs to be taken care. Let me sort of remind what Professor Abhijit Banerjee said in a lecture days before when it was announced that he will get Nobel Prize. He said that the consumption has gone down, and it has never happened in many, 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 many years. So I've counted, he said 5 times. This is where we are right now.
So if you want to broadly look at solutions, or at least approaches towards solutions.
Yeah, and let's restrict it only to, let's say, this financial year or 2020, right?
Yeah, I'm not talking about the
long-term,
standard structural things.
Structural reforms and all that.
So,
okay.
So my biggest problem is the standard response in a macroeconomic crisis would be fiscal pump priming. And I would, even though I'm a fiscal hawk and I would always go against government spending, in times like this is when you're supposed to spend, right? But again, the fact that we've been overspending all of these years naturally curtails our ability to go overboard and spend. But even then, I would say, if ever there was a time when I would approve of government spending, it would be now. Okay, so they have my blessings.
I have noted this.
Yeah, you can send a message
and I support Anupam.
You can send a message to Nirmala saying Anupam says okay. Okay. Now, but even then, you got to be careful about what you spend on. Just massive fiscal transfers might not be the way out of this, because if people's expectations are not great, it will not. So just giving them more money will not naturally result in them getting money, and then you have to decide who gets the money. Is it the rich? Is it the poor? Is it the middle class? Who has the most propensity to consume, and all of those things, right? So transfers might not be the best option, but I would still say if the government has to spend, it has to be on investment, right? And then the multiplier and the accelerator effect will take place, and hopefully you'll get kickstart the economy in some way. And this is also the time when you spend on things that normally you wouldn't have the money to spend, or you're slightly bearish about spending, right? If you want to build a massive road network, this is the time. You want to lay down new infrastructure projects, this is the time. You want to build a port, again, go for it now, right? This is probably the best time to undertake some of these infrastructure spending that you otherwise wouldn't do, right? Because you're too caught up in the election cycle and so on.
Anupam is sounding a bit Keynesian now.
Yeah, very rare. But I think, if you have to do that. So that's a short-term measure. What that will do is essentially, by in those investments, you will also raise incomes. With the hope that people will start spending those things and the economy will get kick-started. That's the here and now. And also, I think the larger aspect, which I said, which is the investment problem, the structural aspect, I won't get into the big things, but I think now you have also a justification for doing some of the tough reforms, which is basically bank reforms. That is a no-brainer. I mean, you have to do that, and now is probably the best time. So I'm saying it is a long-term reform, but it has to be started this financial year.
Great. So thanks to both of you. I think Anupam and Apurva gave us an accurate but a gloomy picture of what's happening in the economy. Probably that's how it is, and we need to think of some of the reforms that were spoken. So maybe next year when we have the same episode of ATP, we'll have some good news to share. So until then,
Hopefully.
thank you.
If you liked our show, don't forget to check out other interesting podcasts on the IVM network. You can tune into them on the IVM Podcast app, ivmpodcast.com, or wherever you listen to your podcasts. You can also follow IVM on social media. The handle is @IVM Podcasts on Twitter, Facebook, and Instagram. And hey, if you'd like to dive into Takshashila's research on technology, strategy, and economic affairs, check us out at our Twitter handle @Takshashila INST or our website takshashila.org.in.
I hope you enjoyed that show. We'd like to thank our sponsors this week, Intel, Storytel, and Cambly. This week, in the spirit of Christmas, instead of giving you the long, drawn-out promo that I normally do, all I'm going to do is ask you to give me a Christmas gift. Go to ivmpodcast.com/survey, fill out our survey, and send it out to us. We'd really appreciate it. Thank you so much for listening to the IVM Podcast Network this year in 2019.
The modern world is obsessed with food and agriculture. Everywhere you look, new and exciting technologies are bringing food innovation to your street market, your grocery store, your doorstep, and your plate. From our quest for the perfect food photos to our rediscovery of ancient grains. Quite simply, food has never been sexier. But guess what? The modern food system is broken. It's a major cause of climate change, antibiotic resistance, and global poverty. So how did we get here, and where are we going? Most importantly, how are we going to feed 10 billion people globally by the year 2050 through better, more sustainable means? I'm Varun Deshpande.
And I'm Ramya Ramurthy. And we work for the Good Food Institute, a global non-profit accelerating the transformation to a more healthy, sustainable, and just food system. The next food revolution is here. On Feeding 10 Billion, we're giving you the inside view. You can tune into us every Tuesday on the IVM Podcast app or ivmpodcast.com or wherever you get your podcasts from.